Corporate Finance Excel Practice Problem. In this presentation, we're going to take a look at a practice problem in Excel related to required new fund formula, a formula that is used to think about the new funds that might be required for the expansion of a company. We're going to have the situation where all balance sheet accounts change relative to sales. Get ready. It's time to take your chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We're going to be focusing in on this formula, which is the required new funds formula as we go through, thinking about the funds that would be required as we project out into the future. Our data on the left says the sales last year, so the sales that we know last year, 110,000. The assets and current liabilities will vary directly with sales. So meaning the relationship between sales and the balance sheet accounts for assets and the current liabilities will vary directly with relation to the sales. We're going to use that assumption in order to calculate and put together our formula. We have the balance sheet then, the balance sheet as of the prior period, at the end of the last period. We have our assets here, our liabilities and equity then. Then we have the profit margin percent is going to be 10%. The dividend payout ratio is going to be 55%, and the estimated growth in sales is going to be 25% increase in the following year. So how much new funds are needed to finance the growth that we're going to be needing? So we're going to be using this formula here, and I'll explain the formula, then we'll break that formula out into kind of like a vertical type of fashion, which I think it'll be a little bit easier for us to kind of isolate and concentrate in on each component of the formula. So if we break out this formula, we can think of it as kind of our components of our accounting equation, where the first component, this piece right here, is going to be related to basically assets, this one related to the liabilities, and then this related to basically the equity section. If you think about assets equal liabilities plus equities, or if we think about the formula of assets equal liabilities plus equity, then we're thinking about the assets are the things that we're going to have financed in one way or the other. We're going to finance the assets either with third-party liabilities or equity. So if assets are to go up, then the liabilities or equity are going to have to go up in order to finance the assets, right? So if we think about the first half, this is going to be the asset portion of the formula, and then the liability portion, and then the equity portion. So we have assets divided by the sales. This is for the prior year, the year that has passed, not the budgeted or future year. We're going to multiply that times the change in sales, meaning the projected sales minus the current sales in the prior period, minus the liabilities over the sales, this being for the prior period, the period that has passed, not the projected period, times the change in sales, which is going to be the current or the projected period minus the prior period. And then we're going to subtract out the profit minus the dividends in essence. So we got the profit margin times the sales for the year two that are going to be projected out. These are the future sales. That would be the increase in equity. And then, so because that would be like the net income number. And then we're basically going to say 1 minus the dividend payout ratio, which will be the dividends that we pay out basically of the revenue. So this will be kind of like the net increase in the equity. So we're going to look at the assets that are going to increase. How are we going to finance them? Increase in liabilities minus the increase in liabilities minus the equity increase, meaning the net income that we expect to have that isn't distributed out in dividends. So let's break these three components in like a vertical fashion. Obviously, you could plug this information into the formula and work it out in an algebraic format. It's useful to break it out in like a tax return type of format to break these out to the three sections in a vertical type of format, because that will help us to kind of isolate these components of the calculation. So let's think about this first component first, the asset component basically. So if we take the assets in the current, so we're going to start off with our assets here. We're just picking up this first component of our formula. I'm going to write it down kind of vertically. We're going to pick up the 121, and then we're going to pick up the sales, and I'm going to be picking up the sales for basically year one, the component that has passed. That's what the S1 stands for. So we're going to say, all right, that's going to be the 110. Let's go ahead and underline that. Home tab, font group, underline. This is going to be a subtotal, so I won't put any name to it. I'm just going to say 121 divided by the 110. I'm going to pull that into the middle column here. Then I'm going to put some decimals, home tab, and the numbers group, adding decimals. Looks like it rounds evenly nicely to 1.1. And then we want to think about the change in sales. The change in sales, that's going to be this component. Change in sales is going to be the sales for year 2, or the projected sales. You can think about them. So projected sales for year 2. I'm going to go ahead and unformat that, and we're going to say this is going to be equal to the sales here times, and we think it's going to go up, it said by 25%. So what I want to do is say, I got times up top. I'm going to say brackets 1 plus the 25%, or 125%. So we're increasing it by 25%, or we're taking that amount times 125%. And so that's going to be the 137.5. And then we got the sales in year 1, which are going to be equal to, I'm going to unformat this for now, equal to the 110. I'm going to underline this. Let's underline this, and then we will subtract them out here. So I'm going to say this will equal this number minus this number. This is the change in sales. Tab, tab. Now I'll do the formatting. I'm going to select these 3 tabs. Home tab, font or alignment, increase the indent. I'm going to increase the indent here again. So home tab, alignment, increase the indent again. So there we have that, and then we're going to pull out the total over here, which I'm going to multiply these 2 columns. So note what we have is we've got this ratio that we took, assets compared to sales, which we believe is going to remain constant, and then we took the increase, the change in the sales, and we're going to apply that ratio to the increase in sales for the first part of our equation for basically the assets part to estimate what the increase in the assets will be. So we're going to say, all right, there's the 1.1 times the 27.5. That's going to be our increase in the assets. Now we need to see how that's going to be financed then, either through liabilities and equity. And you can kind of see what the assumption here would be. Notice you're saying, we're basically saying, hey, if you want the sales, if the sales were to be remaining the same here, then you can have the same amount of assets for basically a return on the assets, the investments that you have. If there's going to be an increase in the assets, in this case, in revenue, the 27,500, then you would expect then the assets needing to be increased relative to that in order to generate that added revenue. And so we're going to increase them by the ratio that we have of the 1.1. Okay, so that's the first component. Now we got to think about how we're going to finance that, liabilities and equity to do that. So let's think about the liabilities component. So we're going to say, now we're going to pick up the liabilities. We're on this portion here, which is going to be equal to the liabilities in the current time period. So we'll pick up the liabilities, and we're picking up just the current liabilities. We're saying the notes payable is not going to change in the same way relative to sales. So we're going to pick up the current liabilities, and we're going to be picking up then the sales in year 1. Similar kind of comparison we had for the assets. We're going to be picking up the sales for year 1, and then we're going to divide that out. So let's underline here, home tab, font group, underline, divide them out. I'm not going to put a name into it. This is a sub calculation. 40,000 divided by the 110. Let's add some decimals. Home tab, the numbers group, adding a few decimals. Notice it goes on for some time. So this is a rounded number. So you're going to have to deal with the rounding here. When we use this number to calculate, it'll use the actual number, even though it's rounded to about 0.36. Okay, so then we're going to say that we're going to take that times the change in sales. So the change in sales, which we calculated up top already to be the 27.5. And then we're going to underline that, go into the home tab, font group, underline, and then multiply this out. I'm going to bring this into the outer column. This is going to be the 0.36 times the 27.5 and enter. Basically, we can think, okay, the assets are going to need to go up by the 30,250. Liabilities will go up in part to kind of finance part of the asset increase of the 10,000. Let's think about what's going to happen on the equity side of things. So equity side of things, we're going to take the profit margin. Let's pick up the profit margin, putting that here. I'm going to put this in the middle column. That's going to be equal to the 10%. So 10. And I'm going to multiply that. Let's make it a percent. Home tab, numbers group, make it a percent. We're going to multiply that times the year 2 sales. Year 2 sales, which we saw up top, we calculated it to be the 137.5 already, which was the 110 times the increase of the 25% or 125%. Now, if we multiply those two out, that'll basically, let's just do that over here in a side calculation. If I multiply those two out, the 10 times the 137.5, that's going to be basically our net income. So the net income would be the increase in equity, but then we have to pay out the dividends, right? We got to pay out the dividends. So we're going to do that in our formula, we're going to take a look at the 1 less the dividend percent. So let's see what that would be. That we're going to say this equals brackets 1 minus the dividend percent, which is the 55% dividend payout ratio, 55% brackets. And I'm going to make that a percent, home tab, and numbers group percent. So in other words, we're paying out dividends of the 137.5 times we're paying 55% out in dividends. That's how much of the net income we're paying out in dividends. Let me do that one more time. That's not quite right. This equals the 13,750 of net income, not sales, times the amount that we're going to pay out. We're paying out 55% in dividends. So that would be the 7,563. So the net, this would be the amount of dividends. So the net then, the net increase in equity would then be the 13,750 minus the dividends, or the 6,188. I'm going to underline that, home tab, font group, and underline. So if we look at it this way, we can multiply these three numbers out. These two will be the profit margin. This is the amount that if we're going to pay out 55 in dividends, we're going to keep 45%. So I can get to the same number, and it's a little bit nicer and cleaner or shorter to do in this format, in this formula, right? So we can then say, okay, take the profit margin times the sales gives us net income times the amount that we didn't pay out in dividends. And that's going to give us that same 6,188, the amount that we're going to have increase in equity. So then we need the new funds. So new funds needed will then be, well, we know that the assets we're going to think that they need to be increased by the 30,250, and we're going to finance that increase by the liabilities increasing by 10,000, so minus 10,000, minus the net increase in equity after we pay out the dividends, means we're going to still need funds of the 14,063. Let's put an underline here, home tab, font group, and underline. So notice again, we have kind of a lot of assumptions being made here, but you can see how this could be a useful type of calculation to give us an approximation of what's going to basically be taking place and how much funds could be needed in the future. So we can alter the approximations that we might have as well, because notice we took something like total assets here, saying that the total assets are going to change with relation to an increase in the profit. That might not be the case, because maybe we're going to keep fixed assets the same. So maybe we want to just change current assets that are going to change relative. So that could be a variant, and we'll take a look possibly at a variant like that in a following presentation. So you could do different projections based on this kind of idea, but you can see how the idea plays out, and then you can basically make variants on it. Meaning, if there's a relationship between the sales increasing and basically the balance sheet accounts, what you're going to need in order for the sales to increase, the assets, basically thinking about an asset turnover kind of perspective as the assets, or return on investment type of calculation. As the assets go up, you're going to need more assets in order to generate the increased revenue. And then, of course, how are those assets going to be financed, either with liabilities increasing and or the equity increasing. Equity then increasing through the net income that will increase less the amount that's paid out to the owners in the form of dividends.